Something happened that affected virtually every working American. Not a headline. Not a press conference. Not a segment on the evening news. A quiet administrative update buried inside the IRS's annual inflation adjustment publication. 37 pages of regulatory language that almost nobody reads and almost everybody is affected by. I read it. And here's what I found. 7 specific rule changes that went into effect for the 2025 and 2026 tax years that the majority of people filing taxes this year either don't know about, haven't adjusted for, or are actively leaving money on the table because of. I want to be precise about what I mean by leaving money on the table. I don't mean theoretical money. I mean real, calculable, this year dollars that will either stay in your pocket or go to the IRS depending entirely on whether you know these 7 things before you file. My name is Money Sketcher, and I sketch out the financial patterns most people can't see until it's too late to act on them. If you've ever filed your taxes and had the quiet feeling that you probably missed something important without knowing what it was, subscribe right now. Because today we're going through every one of them. Standard disclaimer: I'm not a tax professional or CPA. Nothing here is personalized tax advice. These are publicly available IRS rule changes that every taxpayer should understand. For your specific situation, consult a qualified tax professional. But understand this first, because the conversation with your advisor goes better when you know what questions to ask. Let's sketch it out. Most people think of taxes as something that happens to them. The government takes what it takes and you pay what you owe. The rules are the rules, and unless you're rich enough to have an accountant gaming the system, there's not much you can do about it. That framing is wrong. And it costs people real money every single year. Here's the more accurate framing. The tax code is not a fixed bill. It's a set of rules with embedded opportunities that are available to anyone who knows they exist. The IRS doesn't notify you when those opportunities change. They publish the changes in regulatory documents and assume you'll find them. If you do, you benefit. If you don't, you pay. The entire system is built on the assumption that most people won't look. That most people will file the same return they filed last year with minor updates and miss the changes that went into effect since then. The 7 changes we're about to cover are not exotic loopholes. They're not aggressive strategies that require a team of lawyers. They're standard rule updates that affect standard taxpayers doing standard things. The only difference between the people who benefit from them and the people who don't is awareness. For the 2025 tax year, the standard deduction increased to $15,000 for single filers, up from $14,600 in 2024. For married filing jointly, it increased to $30,000, up from $29,200. For heads of household, it increased to $22,500. Here's why this matters more than it sounds. If you were on the borderline of whether to itemize or take the standard deduction last year, those increases may have changed the math. More people benefit from the standard deduction now than at any point in recent history since the 2017 tax law changes, and the annual inflation adjustments keep pushing that number higher. But here's the mistake people make. They assume their tax preparer or their software automatically optimizes this. Sometimes they do. Sometimes they run the default calculation and move on. The rule is, you should know what your itemized deductions total and compare it explicitly to the standard deduction every single year. Don't assume. Calculate. If your itemized deductions, mortgage interest, state and local taxes up to the $10,000 cap, charitable contributions, are below $15,000 as a single filer, you're leaving money on the table by itemizing. The software should catch this. But you should verify it did. For 2025, the 401k contribution limit increased to $23,500, up from $23,000 in 2024. The IRA contribution limit held steady at $7,000. But here's the change most people missed entirely. The catch-up contribution rules changed significantly for people aged 60 to 63 specifically. Under the Secure 2.0 Act provisions that went into effect in 2025, individuals aged 60, 61, 62, and 63 can now make a super catch-up contribution to their 401k of up to $11,250 instead of the standard $7,500 catch-up that applies to people 50 and older generally. If you are between 60 and 63 years old right now and you have not adjusted your 401k contribution to reflect this higher limit, you are missing a tax deferral opportunity worth up to $3,750 more than you may have thought was available to you. That's $3,750 of income that doesn't get taxed this year. At a 22% marginal rate, that's $825 in real tax savings. This year. Not someday. This year. Log into your benefits portal. Check your age bracket. Adjust if necessary. Every year the IRS adjusts the income thresholds for each tax bracket upward for inflation. This is called bracket creep prevention, and it means that if your income stayed roughly the same as last year, you may actually owe slightly less in federal income tax because the bracket boundaries moved up. For 2025, the 22% bracket for single filers now begins at $48,475, up from $47,150 in 2024. The 24% bracket begins at $103,350 for single filers, up from $100,525. For married filing jointly, the 22% bracket begins at $96,950. Here's why this practically matters. If you received a modest raise this year and your income crossed a round number that you worried pushed you into a higher bracket, it may not have. The bracket thresholds moved. Run the actual numbers before assuming you jumped a bracket. And more importantly, if you're doing any deliberate tax planning, whether that's Roth conversions, capital gains harvesting, or timing deductions, knowing exactly where the bracket boundaries sit this year is essential information. Doing a Roth conversion that pushes you into the 24% bracket instead of keeping you in the 22% bracket costs you real money that better information would have prevented. For single filers, the 0% long-term capital gains rate now applies to taxable income up to $48,350. For married filing jointly, that 0% threshold is $96,700. Here's the opportunity this creates that most people miss entirely. If your taxable income is below those thresholds, you can sell appreciated assets, stocks, index funds, real estate held more than a year, and pay zero federal tax on those gains. Zero. Not a reduced rate. Zero. This is what wealth managers call tax gain harvesting. And it's the inverse of the more commonly discussed tax loss harvesting. Instead of selling losers to offset gains, you're selling winners in a low-income year specifically because the gains are tax-free at your income level. If you're in a year with lower income, whether because of a job transition, early retirement, a sabbatical, or any other reason, and you hold appreciated assets, this window exists. It doesn't require anything fancy. It requires knowing the threshold and knowing where your income sits relative to it. Individual coverage, $4,300, up from $4,150 in 2024. Family coverage, $8,550, up from $8,300 in 2024. I've covered the HSA in depth before and I'll be brief here. The HSA is the only account in the American tax code that gives you a triple tax advantage. Contributions are tax-deductible. Growth is tax-free. Withdrawals for qualified medical expenses are tax-free. No other account does all three simultaneously. The 2025 limit increase means there's $150 more individual and $250 more family tax-advantaged space available this year than last year. If you maxed the HSA last year at the old limits, the new limits are higher and you should adjust. If you haven't been maximizing the HSA, the limit increase is a secondary issue. The primary issue is that you're not using the most tax-efficient account available to you, and every year you delay is a year of triple tax-free compounding you don't get back. The contribution deadline for the HSA for the 2025 tax year is April 15, 2026. You can still fund it after the calendar year ends. Use that window. The annual gift tax exclusion increased to $19,000 per person for 2025, up from $18,000 in 2024. Most people have a vague sense that you can give money to family members without it being taxed, but they're unclear on the details. Here's the clear version. You can give up to $19,000 to any individual in 2025 without it counting against your lifetime estate and gift tax exemption and without requiring you to file a gift tax return. If you're married, you and your spouse can together give $38,000 to any single individual in 2025 without any gift tax implications. For families doing intentional wealth transfers, this is meaningful capacity. A couple with 3 adult children can transfer $114,000 in 2025 with 0 gift tax implications and 0 required filings. For most people reading this, the gift tax exclusion isn't the central planning tool. But it's worth knowing because it creates a legitimate, completely legal pathway for intergenerational wealth transfer that many families don't use simply because they don't know the limit is this high or that it increases regularly. The practical application: if you're supporting adult children financially, gifting rather than lending may be the cleaner legal and tax structure depending on the amounts and circumstances. The Earned Income Tax Credit is one of the most valuable credits available to lower and moderate income working Americans. And its parameters adjusted for 2025 in ways that expand eligibility and increase the maximum credit amounts. For 2025, the maximum EITC for taxpayers with 3 or more qualifying children increased to $8,046. The income limits also expanded, meaning some households that narrowly didn't qualify in prior years may now qualify. Here's the uncomfortable truth about the EITC. The IRS estimates that approximately 20% of eligible taxpayers don't claim it. That's roughly 1 in 5 people who qualify for a credit worth potentially thousands of dollars and simply don't take it. Usually because they assumed they didn't qualify, because their tax software defaulted incorrectly, or because they used the wrong filing status. The EITC is fully refundable, meaning if the credit exceeds your tax liability, you receive the difference as a refund. A family qualifying for the maximum credit could receive $8,046 back even if their tax liability was 0. If your household income is below approximately $57,000 to $66,000 depending on filing status and number of qualifying children, run the EITC calculation explicitly. Don't assume your software caught it. Verify it. The IRS has a free EITC assistant tool on their website that takes less than 10 minutes to complete. Here's what I want you to see when you look at these 7 changes together. None of them are aggressive. None of them are controversial. None of them require a sophisticated tax attorney or a complex transaction structure. Every single one of them is a standard rule change affecting standard taxpayers. What they share is that they all require you to know they happened. The IRS doesn't call you. Your employer doesn't email you. Your bank doesn't send you a letter. The changes happen, the filing season opens, and the people who know the new rules benefit and the people who don't file the same return they filed last year and wonder why nothing ever seems to improve. Here's the structural reality behind all of this. Tax optimization at the level we've been discussing isn't advanced tax planning. It's basic tax awareness. The gap between someone who maximizes their position under the current rules and someone who doesn't isn't a team of accountants or a complex strategy. It's information. Specifically, it's the information in 37 pages of annual IRS publication that almost nobody reads. The financial industry has an interest in making tax planning feel complex enough that you need to pay for professional help to navigate it. Some of that complexity is real and worth paying for in specific situations. But a meaningful portion of the value is in simply knowing what changed and what options that change creates. Action 1. Pull up last year's return and compare the standard deduction you took against your itemized deductions. If you itemized, recalculate whether the new higher standard deduction changes the math. Action 2, if you're between 60 and 63 years old, log into your 401k portal today and verify your contribution rate reflects the new Super Catch-Up limit of $11,250 above the base contribution. Action 3, if your income is modest, run the EITC calculator on the IRS website. Takes 10 minutes. If you qualify and you don't take it, that's a number with real dollars attached that belongs to you and you're leaving it behind. The tax code is updated every single year. The people who stay aware of those updates consistently outperform the people who don't over the course of a working lifetime. Not through aggressive strategies. Through the boring, unglamorous, genuinely valuable discipline of knowing what changed and acting on it before the filing deadline. That's the whole move. Know the rules. Apply them. Keep what's yours. If this opened your eyes to something you're going to act on, share it with one person you know who files their own taxes and probably hasn't heard about any of these changes. I'm Money Sketcher. I'll see you in the next one.